We'll be talking about what we call our multi-method investing financial markets update. To start with, I'm going to do, as usual, a review of market indexes for year-to-date 2025. So if you could pan over here, Mick. What we're looking at here is data from January 1st of 2025 up through the close of business yesterday. All right, so with various indexes. So we'll start with world stocks. And here we're using the FTSE Global All Cap Stock Index, which is like the broadest measure of stocks that we can use. That includes not just US, but also international, developed markets and emerging market stocks, large, mid, and small cap stocks, so extremely broad. That index for year-to-date 2025 is up 18.85%. That index would be composed of various subcategories of different slices of the market. All right, so for example, US large company stocks, and here we're using the S&P 500 index, is up 14.59% for the year. Then we have US mid-cap stocks. Here we're using the S&P mid-cap 400 index, is up 5.52. So differential there, significant differential between large and mid-cap stocks. And then as we go down the line to US small cap stocks, where we're using the S&P small cap 600 index, is up 4.66%, right? So a further decline. And this actually only in the last 2-3 days has gone from just above zero back up to 4.66%. So a big jump in the last couple days. It was near zero at the close of business on Friday. Okay, international developed market stocks, this and emerging market stocks. So basically non-US stocks in general have been the best performers for year-to-date 2025. So international developed market stocks are up 25.51%. And when I say international developed market stocks, we're talking about non-US stocks that don't fit the emerging markets description. So we're talking about Canada, we're talking about Western Europe, we're talking about Japan, potentially South Korea, Australia, New Zealand, etc. All right, so the developed economies of the world. And there's a lot of conjecture about what now constitutes a developed market versus an emerging market. For example, China is a question mark out there. That's kind of on the borderline between the two. So depending on you ask, they may be considered a developed market versus an emerging market. But for international developed markets, they're up 25.51% year to date. They have been the leader for most of the year to date so far. And then more recently, emerging market stocks, which is basically everybody other than the countries I already mentioned, right? That has an investable, functional bourse or exchange, right? They're up 29.43% in aggregate, right? So they're now the best performing investable asset type out there in the marketplace for year-to-date 2025. If we look at bonds, U.S. short-term bonds from the 1 to 5 year maturities, including both corporates, treasuries, and agencies, are up 5.42% versus U.S. aggregate bonds, which includes not just the short-term end of the curve, but also from 5 out to even 30 years, in addition to the 1 to 5 years. Also, treasuries, corporates, agencies is up 6.98%. And then the best performing bond type so far this year in the United States, at least, are Treasury Inflation Protected Securities, or TIPS, which are up 7.43%. Which to some degree, TIPS is a good measure of expectations, investor expectations for future inflation. So that gives you some kind of inclination of what investors are expecting in the coming time period. So that's where we stand year to date. I guess the things that I would point out here are the differential. So short-term or bonds in general have been in this range of low single digits to mid single digits for pretty much the entirety of the year so far, whereas there's been a bit more fluctuation in the world of stocks. Big differentiations here in stocks are that there's a huge differential between the performance of U.S. stocks versus international stocks. A lot of that has to do with the dollar and movement, a weakening dollar and movement away from the dollar, potentially as largely driven by a movement away from the dollar as not necessarily as the primary reserve currency, still the primary reserve currency of central banks around the world, but there is a movement of amongst many central banks, especially in the developing world, to diversify their reserve holdings into other types of assets, other currencies and other asset types. So that is partially what is driving that. Another thing that is driving that differential is expectations for growth inside the U.S. versus outside the U.S. And interest rates inside the U.S. versus outside the U.S. So these are all factors that are contributing to this differential between U.S. and international markets performance. All right, and we can talk more about that later if anybody has any interest. But that's kind of a sideshow. The reality is that's a kind of a sideshow because let's talk about the bigger picture. So if we go over here, let's look at what the markets have done over the last couple of years. Hopefully you can see this graph okay. This is obviously not exactly to scale, it's hand drawn, but it's a pretty good representation of what's going on. All right, so back on January 4th of 2022, we had the peak of a prior bull market. At that point, we went into a bear market, which troughed on October 13th of 2022. Right? Thereafter, we went into a new bull market, which was not confirmed until January 19th of 2024. A bull market is only confirmed after the fact, after you've already been in it for a certain period of time, because you only know you're in a bull market after you've re-achieved the prior record price from the pre-bear market. All right, that's how you know you're in a bull. All right, that happened only on January 19th of 2024. All right. In the interim period, we experienced something we call a wolf market, which by our definition is an environment of heightened volatility, but no real clear bull or bear trend. And quantitatively, we define it as a period of a decline, a cumulative decline of 10% or greater, but not 20% from a peak, plus the recovery back to the pre-correction peak. So that happened between July 27th of 2023 and December 8th of 2023. All right, so we have this dip and recovery that happened at that point. Following that, we went into something that we call an eagle market. So both an eagle market and a wolf market are subsets of the traditionally defined bull market. So if you talk about definitions of these four different market types, we have bear, bull, wolf, and eagle. Bear is very easy to define. It's a cumulative decline of 20% or greater from a record peak price. Right? By traditional definition, if you're just looking at bull and bear markets, a bull market would be everything except for a bear market, right? That's the simplest way to look at it, right? But the reality is the financial markets are far more complex than that, and one of the ways you can reveal some of that complexity is by using this idea of wolf and eagle markets, which by our definition are subsets of the traditional bull market. All right, so they're basically subcomponents of that larger bull market. So I talked about the wolf market. Immediately following that wolf market, we went into something called an eagle market, right, which lasted from December 8th of 2023 until December 23rd of 2024. Now, an eagle market, by our definition, is an environment of rapidly rising or soaring asset prices without any intervening 10% plus correction. Right, and from a quantitative standpoint, we're talking about trailing returns of 30% or greater on a one-year trailing returns of 30% or greater without any 10% intervening 10% drop. So again, that's what we experienced here. And after December 23rd of 2024, the returns tapered off and dropped below that 30% per year mark. Following that, we achieved a peak price on February 19th of 2025 of this year, so earlier this year. We didn't know that was a peak price in the bull market until we registered another bear market, right? So we registered another bear market on April 7th of 2025, which you see here. Most people didn't even really read about that in the news or hear about that in the news, because it was registered as a bear market, a cumulative decline of 20% or greater on an intraday price basis. So meaning looking at all the different prices that occur during on any given day, on the starting day and the ending day, but it did not register as a 20% decline on a closing price basis. So most of these news outlets out there are looking at only the closing price data, reporting on that. They did not necessarily report this as a bear market, but we did register it as a bear market when looking at it on an intraday price basis. So we registered this bear market, which on April 7th, 2025, that confirmed in arrears. Again, all of these things these bear market types get confirmed in arrears, right? You don't know what market type you're in until after the fact, until another type of market gets confirmed. Then you know in arrears what type of market environment you were in previously. So on April 7th, we knew that February 19th of 2025 was the peak of the prior bull market that started on October 13th of 2022. So that bull market went from October 13th, 2022 up to February 19th of 2025, and during that lasted 2.35 years, right? And we had a cumulative gain from trough to peak of 76.06% during that time period. Right, so if you took $100 and invested it on October 13th and waited until February 19th, you would have $176.06, right? $176.06 on February 19th, just to keep it simple, right? Now, following that, this really, everything after February 19th, this is just to give you background, right, of what has happened previously. What is happening now is of greater interest, right? Looking forward in terms of making decision making for portfolio management purposes. Okay, so February 19th, we have the top. April 7th, we register the bear market. We didn't know at this point that this was a bear. Well, we knew it was a bear market, but we didn't know this was the trough of the bear market, right? Because at this point, you don't know what's coming forward. This could have gone down here, right? This could have gone down 40%, whatever. Your guess is as good as mine, right? But instead, what happened is we had an extremely rapid recovery, and just like before, when we re-achieved that prior record price, we did that same thing here. We had a very short bear market with a very rapid recovery, and we re-achieved the prior record price on June 27th of 2025 over the summer, right? So now we knew, again, in arrears, this is a bull market indication. We have been in a bull market since April 7th of 2025, and that was clarified or confirmed on June 27th of 2025. That has continued so far up through at least October 10th, so at least Friday, right? It has continued up at least, so that's an additional, this is very small, but I'll read it to you. So as of October 10th of 2025, that's an additional 3.5 months after the June 27th indication date, and that's an additional 10%, exactly 10% cumulative gain over that time period. So all in all, up through October 10th, this bull market so far has lasted 6.2 months at least, with a cumulative gain of positive 39.86% from April 7th until October 10th, right? Since then, on the 10th, right, we peaked that day, right, or had the most recent peak was that day, and then we had a decline of like 2.75% the same day, right? And we ended about 2.75% down on a closing price basis that same day. That doesn't mean this was a peak, right? And we're not going to re-achieve, right? It's just the most recent peak. So since then, in the last 5 days, as of the close of business yesterday, we saw this drop of 3% approximately, and then we've regained some of that ground. So now we're about 1.35% off of the record from October 10th, just during the last week. So this is just kind of a recap of where things stand as of right now, right? Okay, so looking at this, what does all this mean? That's just what happened, but what does it mean? And one of the ways we can assess what it means, if you can come over here, Mick, is looking at the history of the financial markets and looking at averages of these different market types in terms of average length and average gains and losses during these time periods. And we can also look at some other factors like probabilistic analysis, which I'll get into. All right, to start with, one of the things that we've done as a firm is we've done an analysis of market history, specifically on the S&P 500 since 1950, looking at all these 4 different market types during that time period, which is about 75, 76 years of market history, which is back, it's far back as you can go with significant or with good statistical data, right? Without coming up with assumptions and proxies and that kind of thing. So with good statistical data, the furthest back you can go is 1950, especially with the S&P 500, which is the most widely utilized index these days. So that's what we're using as our measurement tool, right? So if we look at that, if we look at the analysis of all that data since 1950, and I will also mention that we actually just updated our data up through April 7th, whereas previously we were even using data from 5 years prior. We just reanalyzed the entirety of market history with an additional 5 years of data. So I've now updated. So if you look at our analysis from last month, in which point this data was not available, versus this month, the numbers are slightly different. Some of the averages obviously are going to change slightly, but in review, none of the outside ranges have changed. There's been nothing so extreme that it changed any of the ranges that we were using prior to this. Okay, so all that being said, if we look at first, let's look at bull markets from trough to peak, right? So meaning the absolute bottom of a bear market until the peak of a bull market that precedes the next bear market. If you look at all of those throughout history, the shortest time period was 1.15 years. So the shortest bull market in history was 1.15 years. The longest was 9.55 years. And the average amongst all of those was 3.97 years. So the average bull market is about 4 years, right? In terms of gains during that time period, the smallest gain was 44.62%. The largest was 341.05%, with the average coming in at 128.07%. Okay, so now let's look at our bull market so far. Our bull market so far has been 6.2 months versus the average 4 years, right? So like an eighth of the average. And our gain so far is 39.86% versus the average 128.07. So both of those things would indicate that we are still very much in the early stages of this bull market. And that if it were to turn around now, it would be by far the shortest bull market in history. So that is an extremely low probability event for us to go into a bear market right now, right? Okay. Furthermore, another way you can look at this is bull markets from the point of indication, in this case, June 27th of 2025, until the next peak, right? That's another way you can measure this. And if we look at it from that standpoint, the shortest time period in history before we went into a new bear market was 6 days, so much shorter, right? And the longest was 7.44 years. The 6 days one that's the one they called the lost decade that preceded the financial crisis of 2008, 2009. So 6 days to 7.44 years. Not surprisingly, the 7.44 years was the bull market that followed the financial crisis, right? So both of those are associated with the financial crisis, both extremes. But the average, if you look at it back since 1950, is 2.19 years. So you get basically an additional 2.19 years of growth after your bull is indicated. In terms of results or returns after that time period, the lowest was 2.09%, which again is associated with that 6 days, and the highest is 225.74%. And the average comes in at 49.75. So far, in this case, we've only seen an additional 3.5 months versus the average 2.19 years, and we've seen an additional gain of 10% versus the average of 49.75%. So like 1/5 of the average, right? So both of these things together, if you look at from bulls from trough to peak and bulls after indication to peak, would tell us that we are still very likely in the early, very early stages of this new bull market. Okay. Now, I will tell you there's another way to look at this. Even if you took like the most pessimistic view here and said that, okay, this was this little bear market we had from the 19th of February to April 7th, it was just barely a bear market. We only went down 21.35%. What if we just considered that a correction, right? In this broader bull market that started October 13th of 2022, right? Even if you took the most pessimistic view, which we don't, right? But if you did that, then even then, we're talking about a bull market that would be, 2.35 plus another 3.5 months. So we're talking about we're talking about even then, giving the average of 3.97 years, we'd still at 2.6 years, right? We'd still be significantly less than the average length of a bull market, right, at this point now. So basically, no matter how you cut it, if it is extremely unlikely that we go into a new bear market anytime in the near future, right? Anything is possible, right? But if it were to happen, it would be the first time in history that happened. Keep that in mind. Okay. However, right, so all that is good so far. That's all very positive in terms of how to position your portfolio in terms of outlook for stocks for the financial markets. There's a big however here, right? Another thing we look at is corrections and what we call a wolf market, which I described earlier. Remember, the wolf market is where you get a 10% plus correction, but not 20%, and the recovery back to the pre-correction peak price. If we look at those, how often do those happen historically, right? And what's the severity of them, right? Well, the average time between either a bear trough or a correction trough and a new peak, right, that precedes either a bear market or a wolf market, the average time is 1.1 years, right? Or it's exactly 400 days, approximately 400 days, 397 days, something like that, right? So which is basically 13 months is the average time before you get a new correction, right? And additionally, the average number of wolf markets between a bear market trough and a new bull market peak is between 2 and 3. It's like 2.5, right? 2.5, the number of them. And there's been as many as 5 or 6 wolf markets intervening or intersecting some bull markets in history, right? So far in this particular bull market, we have 0 that right? There was one instance historically where there were no wolf markets between bear markets or during a bull market, and that happened between between 2018 and 2020, so very recently, right? This is the pre-COVID bull market that got cut short by COVID, right? So there we never experienced any intervening correction, but every single other time in history there's been at least one, right? And most of them have averaged 2 to 3 up to 5 or 6, right? Okay, so all that being said, right now, right, so the expectation would be then, based on history and based on probabilities, that the next thing we need to look for is a potential correction of 10% plus. When does that happen? Well, usually if you look at the history of wolf markets, you're talking about, on average, they are going to be anywhere, like I said, they're going to be is about 1.1 years out, right? But they tend to follow a pretty normal distribution curve around 1 year around that number. So most of them are going to occur, right? The bulk are going to occur around that one year out, but they'll start about 6 months out and then come up, and then there'll be less of them about a year out, right? So what does this mean? It means and now we are 6 months in, right, to this bull market. So that means, in theory, we should be starting to prepare for a potential correction, right, in this broader bull market, a 10% plus correction. Okay, other things we want to look at here. So everything I've talked about so far is this idea of historical market type data analysis, the 4 different types of markets, and looking at the history of those and determining what they mean for the future potentially. Another thing we can look at, another angle we can look at this from, is a probabilistic analysis. So in the probabilistic analysis basis, what we do is we look at a series of asset types that basically mirror a lot of what you saw, what we explained earlier from the year-to-date asset type returns. And we reassess those asset types every day. We basically create what's called a probability distribution curve that tells us whether, for each of these asset types, that tells us whether these assets are over or undervalued relative to their own history, meaning they're cheap or expensive relative to their own history, and also relative to the other asset types. So we can also rank them and determine which asset types are the most undervalued, which are the most undervalued. So that's called probabilistic analysis. And if we do that, and we group just very broadly stocks versus bonds, stocks look like most investable stock types are ranging from anywhere near fair value, so fairly priced, they're not cheap, they're not expensive, to slightly overvalued, meaning slightly expensive. And when I say slightly expensive, if anybody who has a statistical background, when we say that, we're talking about anywhere from positive 0.5 to positive 1 standard deviations above the long-term average. Right, so that's not very expensive at all, right? It's slightly overvalued, right? Same thing with bonds. Bonds are fitting almost exactly the same range. Most of them are near fair value, but some of them are trending towards slightly overvalued, right? So and even some of the ones that are near fair value, right, are actually in the negative in terms of standard deviations, meaning they are actually just minimally below their long-term averages. So there's a range around which we will call fair value, right? So they're near fair value, not exactly at fair value. Okay, so what that means from a probabilistic analysis basis is that we don't have to be real concerned about valuations right now, right? They're near fair value to slightly overvalued. And why am I not concerned about slight overvaluation? Because there are times when overvaluations can persist, even extreme overvaluations can persist for extended periods of time. I'm talking about years, right? So an example of that happening would have been post-financial crisis during the quantitative easing period, where central banks were pumping money into the system and supporting financial markets. During that time period, basically creating artificially creating a 9.55 year bull market. During that time period, valuations remained elevated for years on end before they actually eventually came back down to normal ranges. We're probably unlikely to see something like that now unless the Fed goes extremely dovish, which does not seem to be the case. So yeah, we could probably trust valuations a little bit better now than we could have in the past, but still, there's nothing to be concerned about here in terms of the valuations. Nothing is so overvalued that I'd be concerned about it. Okay, so in summary, we have a bear market trough that was relatively recently identified on April 7th of 2025. And that happened to be, that was the same day it was indicated. So it reached 20% decline and then turned around on the same day. That has happened several times historically. There's basically two rough categories of bear market. There are those that turn around, I would call them bear cubs. I've used this term before. Some of you have heard me use that term. And they basically turn around very quickly after they've hit that 20% decline mark, usually within 30 days or so after hitting that decline mark. And then there are what you might call a boar bear or a mama bear, right? In which case, and usually those are created, and those typically by financial crises. So, for example, the great financial crisis of 2007 to 2009, right? And those are typically created by financial systemic issues, right? Which is not what we've experienced here, right? Okay. So we've seen that. We've seen the bear confirmed on an intraday basis, but not a closing price basis, what I mentioned earlier. So you may not have seen this bear market even reported in the news by many outlets because they may not even have recognized it. They just thought of this as a correction, and they never saw it cross the 20% mark because they didn't think to look hard enough, right? That's the reality. Since then, the bull market has been reconfirmed on June 27th of 2025 because we re-achieved the prior record, and that it was an extremely rapid recovery. And so it's an extremely fast cycle. But because of the fact that this has happened so quickly and it's so early, or it's so little time has elapsed and so little has happened in terms of new gains, right? We are still very likely in the early stages of this new bull market cycle. So that's all good so far. The one caveat is that a wolf market, meaning this 10% plus correction and the recovery, is becoming more and more probable over the next year, right? So, and again, this is just based on historical averages, historical data. All right, coming over here, outcome and actions. What can we do, right? What does all this mean, for investors? Well, number one, I'd say that this means our overall stock outlook is neutral to slightly positive. And I would lean towards the slightly positive side on this, right? Especially if you're not worried about intervening 10% plus corrections, you have a long time horizon on your investment, and you can ride out a 10% plus correction, you can be pretty positive here with your asset allocation in terms of allocating larger amounts of stocks versus bonds or other asset types. So that basically just I stated that maintain a neutral to slightly positive stance with your investment portfolio, but start preparing for wolf markets sometime in the next 10 to 11 months, because we're already 6 months in here, right, to this bull market. How do you do that, right? How do you prepare for a wolf market? Well, most retail investors are not going to be able to do that themselves. They need professional investors to assist them to make that happen, right? So the way that we do it here at 4Thought is that we do something called multi-method investing, which those of you have watched this before have some knowledge of, but I'll give a very brief idea of it. So multi-method investing is based on using the best concepts or aspects of 4 completely divergent methods of investing and bring them together in the same investor portfolio. And in some cases, manipulating the allocation between those 4 methods of investing, right, to try to achieve maximum to maximize the probability of achieving investor objectives. Now, how do we do that? Right, so bear markets, bull markets, wolf markets, and eagle markets, I mentioned earlier. Each one of those market types has a specific method of investing that tends to outperform the other methods in. So for example, in a bear market, that's where we see liability-driven investing tend to outperform the others in. So liability-driven investing is used by big institutions. We're talking about insurance companies, banks, public pensions, endowments, etc. It's not typically used by the retail investor, but it can be applied there, which is one of the things we do for our clients. What it entails is quantifying your risks and liabilities, finding a perfectly offsetting asset, and purchasing that asset to transfer risk to another party. Right, so it typically involves heavy use of fixed income instruments, derivatives, and insurance products to try to transfer that risk and basically hedge your risk. And that's where that tends to outperform in bear markets, because if the market's price is declining and the stock markets are declining and you've transferred your risk to another party, you don't care, you're going to be made whole at the end of the day, right? To keep it simple, right? Then in bull markets, the best performing method of investing tends to be strategic asset allocation, otherwise known as modern portfolio theory. This is what everybody's familiar with. If you're an advisor, if you've done any investing yourself, it's the idea of building a diversified portfolio of stocks, bonds, and other asset types, setting a percentage split between the different types of assets, and rebalancing back to that split over time, really only making changes to the investor portfolio based on changes on their objectives and their investor life cycle. So not making changes based on expectations for future, for what the future holds in the markets, right? That does best in a bull market because you have a diversified portfolio and broadly rising asset prices. That rising tide lifts all boats. Your portfolio does well. Your risk is minimized, and that is historically the most applicable approach. Then in something we call wolf markets, which actually account for a very large proportion of market history. It's around 24 to 25% of market history could be considered a wolf market. So in that type of environment, it's opportunistic investing that tends to do the best. So opportunistic investing, it's a very broad category, but it includes things like hedge fund-like strategies, absolute return strategies, tactical portfolio allocation, etc. Basically, what ties them all together is they're trying to beat the market in one way or the other, upside, downside, or both, or trying to provide low correlation returns with the more traditional stock and bond investments in the portfolio. And because of the active manipulation that is allowed, right, that is permitted in that type of approach, they have at least the capability, right, to capitalize on this type of volatility, whereas the other four methods do not by definition, right? So at least, even though it's very difficult to do it, it's to actually execute on it and do it correctly, at least they have the capacity, the capability to do it, where the others simply do not, right, by definition. All right, lastly, eagle markets, what does best in eagle markets is something we call selective or concentrated investing. And as an example, a really simple description is somebody like Warren Buffett or a private equity fund, or something like the more selective styles of value and growth investing, growth stock investing, is basically what they're trying to do is choose a very select portfolio of companies or stocks or fixed income instruments to invest in. Not worry about diversification, not worry about tactical portfolio manipulation, not worry about risk transfer, but just focus on knowing as much as you possibly can about the very select portfolio of companies you're invested in and manage your positions accordingly, right? And because of the fact that those methods are concentrated, that gives them the ability, right, to, again, outperform in eagle markets. Because if we have a rapidly rising, broader marketplace, the only way you're going to beat that is to be either more concentrated in the market, which you do in selective or concentrated investing, or to use leverage, right? That's another option, right? But selective or concentrated investing tends to outperform during eagle markets. Okay. So, if we are coming back to our situation here, if we're in a situation where in a bull market, we know have been in a bull market since April 7th, but our expectation is, based on this analysis we did, that we are probably, the next phase of the market cycle is most likely going to be a wolf market, then it makes sense that we want to have our allocations in place for the appropriate amount of fixed income for the portfolio, based on the investor's risk tolerance. We would have a significant portion of the portfolio in strategic asset allocation to take advantage of the broader bull market, but we want to start increasing our allocation to opportunistic investing in anticipation of an upcoming 10% plus correction and a wolf market, right? So that's why we're saying over here that we want to start allowing overweights to opportunistic investing. We want to allow underweights to selective or concentrated investing, because we don't see that being the primary or the most likely outcome for the marketplace right now, although it is entirely possible. And then neutral allocations to strategic asset allocation and liability-driven investing. So again, overall, starting to allow overweights to opportunistic to capitalize on that wolf market when and if it does come, right? Okay, looking down a little bit more granularly, right, at relative valuations. Like I said, we do probabilistic analysis to, evaluate stock and bond types to see whether they're cheap or expensive. If we look at those, right now, U.S. mid-cap stocks look the cheapest out there in terms of the various asset types that are available. Whereas international developed and emerging market stocks look the most expensive based on their own histories, right? So, and you kind of can see that, and if you look back over here, based on the year-to-date returns, you can see that, for example, mid-cap has not performed very well, whereas international developed and emerging markets have performed extremely well. And over the very long term, at least, things tend to revert back to their averages, to their mean, right? You get what's called mean reversion, and as a result, we are seeing, the valuations as so. Mid-caps being cheaper, international developed and emerging market stocks being more expensive. But again, nothing is too cheap and nothing is too expensive. They're in a relatively tight range. There's nothing really there's no huge opportunities here, and there's no huge risks here either, right? Everything's in this relatively tight, relatively average range. Okay, what does this mean for two types of investors? You have income investors, right? People that are actually taking withdrawals from their portfolio now, right? Because they're in retirement most likely. And you have growth investors, people that are pre-retirement, that are still growing their portfolio, they're in their working years, and they're saving and investing their assets for future use, right? So let's talk about income investors first. I'll jump down. So for income investors, what they should be thinking about is taking neutral withdrawals from their portfolio. When I say neutral withdrawals, not too aggressively withdrawing, not too conservatively withdrawing, but taking a neutral withdrawal from their portfolio. And the way you calculate the neutral withdrawal is you take, and this is something we help our clients with, obviously, right? You take their total portfolio income need, you look at taxes, you look at their living expenses, you look at their other income sources, and you determine what needs to be withdrawn from their portfolio on an annual basis, and then convert that to a monthly number, and that's what we send them each month, out of their portfolio, right? And so on a neutral basis, you do that, it's a straight calculation. And that's the way it should be done right now. There are times when I would say be more aggressive with your withdrawals. For example, if the market was at a high point, and we were expecting an upcoming bear market at some time in the near future, then I would say you're probably better off starting to buffer your cash position and taking a little more out of your portfolio on a regular basis than you normally would. On the flip side, if we were in the depths of a bear market, I might say, be more conservative with your withdrawals and try to take out a little bit less out of your portfolio so you have more of your assets working for you when the market turns around, and try to live off of your cash temporarily, right? And that actually is that last one is actually what we were recommending people do around here, right? Around April 7th. So some people did that. Some people, they weren't able to do that. But those that did it, that means that they may have slightly reduced their cash position, right? Their safety or liquidity fund, right? So for those people who did reduce that safety or liquidity fund, it is now time to top that up, right? So that means we've now had significant gains above the prior record price. If you need to top up your cash position, now is not a bad time to do that, right? And then take now only neutral withdrawals from your portfolio as opposed to more conservative withdrawals. Or take neutral versus more conservative, right? So you can basically up your withdrawal number and put more in and top up your cash position. That's for income investors. On the flip side, for growth investors, same thing, neutral systematic investing into your portfolio. So if you're systematically putting into your 401k plan, your taxable account, trust account, whatever it is, it's IRA, whatever the case is, or some combination thereof, you want to use a neutral systematic investment approach. So not too aggressive, not too conservative, neutral. Same approach as with the income investors. You're going to determine what your total gross income is, subtract out taxes, subtract out your annual living expenses, and what comes out the bottom is what you have available to save into your investment portfolio. Divide that number by 12, you get what you can put away monthly. That's the number that you should be putting in right now, right? No more, no less. Again, same thing, if we were to, if we had a situation where it's the opposite, basically, if for an income investor, so if we had, you were in the depths of a bear market, I'd be saying aggressively put in as much cash as you possibly can during that time period. Whereas if we were at the top, if we believed we were nearing the top of a bull market, we would be saying, maybe thinking about toning back your systematic investments and building your cash position. Neither of those apply right now. It's a neutral approach, right? The other thing that you can do right now is have no fear of cash deployment, because we believe we have this neutral to slightly positive outlook. We believe we're probably very early in this new bull market cycle. You should have no fear of deploying cash. So if you have, if you get a quarterly bonus, right? For example, you're doing your systematic investments, you're putting in your 401k plan, but then you get a quarterly bonus. Or an annual bonus, whatever the case may be. You got a lump sum of cash. It's available to invest. You don't need it for short-term purposes or for some upcoming expense. Get it in the marketplace. No need to dollar cost average in. None of that. Get it in the marketplace. Right? We're not in any situation where we need to do any dollar cost averaging right now. Systematic investing, yes. Systematic investing and dollar cost averaging are not the same thing. We can talk about that separately if anybody wants to discuss that. But no need to dollar cost average. Get that excess cash in the marketplace. Don't wait. All right. That is, in a nutshell, what people should be doing. And obviously, all of this is in the context of their own objectives. So everybody's going to have their own target investment portfolio allocation. And the way we would do that is not just a target asset allocation, but also a target split between the four methods of investing. And that split can differ from one person to another, obviously, depending on their objectives, their risk tolerance, etc. So all this has to be applied within that context on an individual by individual basis. Right? So if you have anybody of your clients, or if you want to speak about this, please contact us. We'll tell you how this applies to you. Okay, so at 4Thought Financial Group, for those of you who are not totally familiar with what we do, we are an SEC, or an independent SEC registered investment advisor only, right? We are not a broker-dealer. We're not owned by any larger company that tells us what to do. We act as a fiduciary for you and your clients. We are not required to sell any proprietary product that some other firm, larger organization tells us to sell. And as a result of that, all those things together, we also, by the way, make sure that we structure our compensation to align with the goals of our clientele, which is probably the most important factor, right? I can get into the details of that if you're interested. But all those things mean that we can be much more objective and much less biased when we're working with you with your financial issues or your clients' financial issues, right? Now, what do we do as a firm? There's three main things that we do, right? We do investment advisory work and portfolio management. And we do that in form of what we call separately managed accounts, which are private managed accounts, managed according to a predetermined strategy that we've developed in-house here. And those follow either one of the four methods of investing I mentioned earlier or some combination thereof, right? And then we mix and match those portfolios for our clients to meet their particular individual, family, or institutional objectives, right? That's the investment portfolio management or investment advisory side of things. Related to that is we do that same thing for retirement plans. So when I say retirement plans, we're talking about we actually act as a 338 fiduciary investment manager for 401k, profit sharing, defined benefit plans, qualified plans that we could install into an existing or to your business owner clientele's businesses if it's a new plan, or we can take over existing plans that they already have installed if they are not satisfied with what they have currently, right? So we can manage that entire process and manage the portfolios according to those same four methods and this multi-method investing approach. Same thing we do for our end user clients, we can do for the participants in those plans. Lastly, we do comprehensive wealth management and financial planning. We do that on a retainer fee basis. So for those clients that are using our portfolio management, we also offer basically an upgrade where we charge their credit card on a monthly basis. And we are on the hook to do most of the things that are associated with their financial life for them, effectively act as like a multifamily office where we are looking at their estate planning, their wills and trusts. We're looking at their business succession planning for business owners. We are looking at their fringe benefits, like I mentioned, 401k, profit sharing, defined benefit plans, other employee benefits. And then we're looking at their investment planning, their retirement planning, their accumulation goals, their planning for college, etc. And then we're coordinating all of those aspects for them and providing ongoing advice and planning analyses for them on that basis, on this retainer fee basis. So all of those things are available to the people we work with.